Hey, if you've ever thought investing is only for people who already have money, this video is going to change that. You don't need thousands of dollars to start. You don't need a finance degree, a fancy job title, or years of experience reading charts. All you need today is $100 in about 10 minutes. By the end of this video, you'll know exactly how to take your first real step toward building wealth. No matter what age you're starting at, not someday, not once you've saved more. Today, with what you already have. Why people delay investing. Let's be honest about why most people delay investing. It's not laziness. It's not carelessness. Usually it's fear. Fear of losing money, fear of doing it wrong, fear of picking the wrong thing and regretting it later. Sometimes it's simply not knowing where to begin. There are so many terms thrown around, stocks, funds, portfolios, dividends, that it starts to feel like a language you were never taught. And sometimes it's the belief that investing is only for the wealthy, for people in suits, for Wall Street types who already have it all figured out. None of that is true. Investing today is more accessible than it has ever been. You don't need a broker in a big office. You don't need a family history of money management. You just need a starting point and a little bit of patience. And if any of that fear or confusion sounds like you, that's okay. That's actually where every single investor starts, even the ones who seem like they know everything now. Nobody is born understanding this. Everybody learns it, usually the same way you're learning it right now. The core concept, compound interest. So let's talk about the one idea that changes everything, compound interest. Here's the simple version. When you invest money, it can earn a return, and then that return can earn its own return. Over time, this snowballs. Your money starts making money, and then that money starts making more money, quietly in the background, without you having to do anything extra. Here's why this matters so much for beginners. Imagine two people. One starts investing $100 a month at age 25. The other starts investing the exact same amount, $100 a month, but waits until age 35 to begin. Both of them keep going until they're 65. On paper, it might seem like the difference is small. After all, it's the same monthly amount, just a 10-year gap. But by the time they reach 65, the person who started 10 years earlier will very likely end up with significantly more. Even though they didn't invest more money overall, across those years they were both contributing. They just gave their money more time to grow. That 10-year head start does something the later contributions simply can't replicate. It gives compound growth more cycles to build on itself. That's the whole secret, and it's not really a secret at all. Time in the market matters more than the amount you start with. Starting small today will almost always beat waiting for a bigger amount tomorrow. How to actually start. Now let's get practical. How do you actually start with $100? Step 1 is opening an investment account. This is often called a brokerage account. And today, many of them let you open one with no minimum balance, meaning your first $100 can go straight to work instead of sitting and waiting until you have more. Step 2 is understanding what you're actually investing in. As a beginner, one of the simplest and most common approaches is a diversified fund, sometimes called an index fund. Instead of trying to pick one single company and hope it does well, a diversified fund spreads your money across many companies at once. That matters because it means your success isn't tied to any single business having a great year. It's tied to the growth of the market as a whole over time. It's a steadier, more beginner-friendly way to get exposure without needing to become an expert stock picker overnight. Step 3 is consistency. This is where the real momentum comes from. Rather than trying to find $100 once and calling it done, set up a small, regular contribution. Even if it's small, even if it's monthly, even if it feels almost too small to matter. Automating this means you're building the habit of investing without having to think about it, decide about it, or talk yourself into it every single time. It becomes part of your routine, the same way a subscription or a bill would be. Except this one is building your future instead of costing you. That's really it. Open an account, choose a diversified, beginner-friendly option, and contribute consistently. That's the entire foundation. Everything else you learn later just builds on top of these 3 steps. Common mistakes beginners make. Now let's cover a few common mistakes that many beginners make. Knowing these in advance can save you a lot of stress, help you avoid costly decisions, and make your investing journey much smoother. Mistake 1. Trying to pick individual stocks too early. It's tempting to look for the next big company that could make you rich. But consistently picking winning stocks is difficult, even for professional investors. As a beginner, it's usually better to focus on diversified investments like index funds or ETFs. They spread your money across many companies, reducing risk while you learn how investing works. Mistake 2. Panic selling when the market drops. Markets don't move in a straight line. They rise, they fall, and sometimes they can be very unpredictable. That's completely normal. Many beginners sell their investments during a downturn because they're afraid of losing more money. But history has shown that markets have recovered from every major decline over the long term. Investors who stay patient and keep investing are often rewarded more than those who react emotionally. Mistake 3. Trying to time the market. Many people wait for the perfect moment to invest. The problem is that nobody knows exactly when that moment will be. Waiting too long can mean missing valuable years of growth. That's why investing consistently is usually a better strategy than trying to predict short-term market movements. Mistake 4. Losing consistency. Life gets busy, unexpected expenses come up, and it's easy to stop investing for months at a time. But long-term wealth is built through regular, steady contributions. Even small monthly investments can grow significantly over time thanks to compound growth. If you've made any of these mistakes already, don't worry. Every experienced investor has made them at some point. The important thing is to learn from them and keep moving forward. Recap in your next step. So let's bring everything together. The biggest lesson is simple. Time in the market is usually more important than timing the market. Starting early gives your money more time to compound. Saving money protects your future, but investing gives your money the opportunity to grow faster over the long run. And perhaps most importantly, you don't need to be rich to start investing. You simply need to take the first step. Remember the key ideas we've covered today. Start as early as you can. Invest consistently, even if the amount is small. Stay diversified instead of chasing the next hot stock. Don't let fear control your decisions during market downturns. And be patient, because real wealth is built over years, not days, weeks, or even months. Here's one simple challenge for today. Open an investment account if you haven't already. You don't have to deposit thousands of dollars. You don't need to become an expert overnight. You don't need to understand every chart or every financial term before getting started. Simply opening the account is often the hardest step because it turns the idea of investing into real action. After that, set a small monthly investment amount that comfortably fits your budget. It could be the cost of a few coffees each month or a small percentage of your paycheck. The amount matters far less than building the habit. As your income grows, you can always increase your contributions later. Your future self will almost certainly be grateful that you started today instead of waiting for the perfect moment. The best time to start investing may have been years ago, but the second best time is right now. Every month you wait is one less month your money has to grow. If this video helped make investing feel a little less confusing and a lot more approachable, let me know in the comments what age you're starting your investing journey. I'd love to hear where you're beginning from. And if you found this guide useful, consider subscribing for more simple, practical videos that break down personal finance and investing into easy-to-understand lessons.